Good afternoon, financial professionals. Abby Fletcher here of E4 Insurance Services, welcoming you to the BREW, Building Relationships Every Week. Thanks for tuning in today. For those of you joining the BREW for the first time, we like to start the BREWcast by celebrating today's National Day for May 26th. Today is National Senior Health and Fitness Day. On the last Wednesday of May each year, approximately 100,000 senior adults will participate in activities across the US of A. Exercise later in life has been beneficial for balance, heart health, and also reduces anxiety. Today, lace up your sneakers with your favorite senior and celebrate their health and fitness. Today on the BREW, as part of our product solution series, we have Brad Mills, who serves as Regional Vice President of Symetra Life. Today, he and his pal Matt will be sharing details about Section 7702 and highlight the unique planning opportunities that exist in this environment. Feel free to use the chat box below while Brad and Matt are live. I'll be keeping a lookout for your questions. Also, excuse me, all attendees are in a drawing for a prize and we'll be announcing the winner shortly. Thank you for tuning in. And without further ado, Brad, welcome. The mic is yours.
Well, thank you very much, Abby. I appreciate that. And, National Senior Fitness Day. I'm not sure if Bill Anderson or Dan Peterson qualify for that, but maybe they're getting close. So lace them up, boys. Anyway, I always appreciate E4's hospitality and don't tell anybody, but you guys are one of my favorite, if not favorite, distribution partners, and the BREW is my favorite WebEx platform. So great to be back, recognize some familiar names, faces, but as Abby said, we're going to go right into a little bit on 7702 and the changes made there that really impacts what we're doing at Symetra and industry-wide. But just a quick refresher, I know there may be a little bit different level of what people understand about this 7702 code, but really what the 7702 regulations being revamped did, they allowed more money to be put into a life insurance policy per the death benefit. So per stated death benefit, say before you could put in, I don't know, $20,000 a year and not be a MEC. So to avoid modified endowment contract status where taxes would be assessed later in life if you pull out money or loan money. So what this allowed clients to benefit from is to put more money per death benefit per the new 7702 regulation. So that went into effect from the Consolidated Appropriations Act that was signed in right at the end of last year, went into effect right here, was passed December 27th, went into effect in January 1. And Symetra was the first major carrier, I believe the first carrier period, to enact these new 7702 rules. So what we did, we stripped it back, did a very transparent view of it, passed on all the benefit to the client and say, here's what you can do. Here's the real effect of that 7702 regulation. And I apologize, I've got a saw going in the background. Hopefully my guy stops sawing. So if it gets bad, Matt may have to take over the slides. But so what it allowed it to do is to put more money into per the death benefit. And we have some case studies that I think will drive this home. But there's a couple other reasons or benefits to the client besides that initial view of the increased cash surrender value and income distribution. So Matt, can you go on to a quick case study, please? And we'll start from there. All right, what we have here is a benchmark comparison of a lot of the different carriers here. And this was a comparison where now some of the folks are starting, you've seen a couple carriers introduce their 7702 products. This was a quick snapshot when we were the very first carrier with this, like I said, and we were, middle of the pack, a little way down. And what we're looking at here for a case study is a 40-year-old male, preferred, paying a 5-time payment, maximum payment you could put in per the death benefit, and solving an income distribution. So what you can see as the pass on to the client, or the benefit to the client, is this: you can put way more money in per the death benefit, and you see the income distribution solved went from $78,000 a year projected to $129,000 a year income solved. I mean, that's huge. So it really allows your client to stuff a lot more money in and pull tax deferred or tax advantage income out. So as you can see, this was a minimum non-MEC death benefit solved. So the death benefit was prior to the 7702 regulations, and all carriers, was around $3 million. And in our solve, it was 3.17. With the new regulations, we were able to reduce that death benefit to 1.8 million, and still stay with a non-modified endowment contract status. So that's pretty interesting how big of a disparity you have there between the old rules and the new rules, and how much more income distribution your client could potentially get out. So we were doing the same exact solve, $100,000 premium for 5 years, minimum non-MEC death benefit, withdrawal to basis, and then loans, and just solving more income. And we'll take a few questions at the end as well. We have a couple of these benchmarks. It's really the same exact story. This is a female 50-year-old paying to retirement, so paying a little longer, paying 15 years instead of the 5-time payment. $30,000 a year payment to age 65, solving the income distribution. Same type of story. Pre-7702, I don't really like how we were down at the bottom of the list. That's going to change, but we were at the very top of this by the flip of the switch of the 7702 rules and the maximum income distribution you could solve. Go ahead, Matt. I think we see a theme here. What do you guys think? From middle of the pack or worse to very top on income distribution when you use this new regulation. So it'll be interesting to see as more carriers come out with their regulations, kind of how we jockey for position at the top. You know, as I mentioned, we took a very transparent view of passing on all the benefit to the client per the regulations. We didn't change anything. We didn't change COI structure. Now, obviously, target premium is kind of a big thing that a lot of people are talking about. Well, targets went down. Well, in our product, the target stayed exactly the same per the same death benefit. Just you could reduce the death benefit more because of 7702, then your target's reduced proportionally. But for the same stated death benefit, it's the same exact target premium. So we'll see if there's a function of COIs changing, or admin charges changing, or targets changing. We have a new release coming out next month, and I think we'll bump targets up a hair on that, but kind of a preview of that. But basically, we did a transparent look, and actually some of our distribution partner friends have kind of used us as really what is a training mechanism on 7702, similar to this, because it's a transparent view of what the change was. Matt, go ahead, buddy. With our new release of our product, I mean, you know, since I'm a regional VP, I have to talk 1 minute on product, right? So with our new product release, I wanted to just give you a precursor to be on the lookout next month for this. We have what's called Symetra allocation index strategies. And what it will do is it's kind of a new look on a more managed style of an account inside your IUL. You know, it's kind of the answer of the set it and forget it routine. So what it does, it takes the VIX, so a volatility control measure from the Chicago Board of Options Exchange. We have an exclusive with the CBOE on this, as to use the VIX as a measure of volatility. So when the VIX is at a stated 16, it means the market is high, it's in flux, high volatility. So we'll switch you over to the JP Morgan low volatility count. When the VIX is lower than 16, we'll put you in the S&P 500, actively managing your account for growth potential. Be on the lookout for that. We're excited about that. We've applied for a patent. We think it's very innovative and follows our transparent rules and easy to understand. Just gives you another option for your clients. Feel free. Now, I mentioned the minimum non-MEC scenario. And also really kind of take a step back. One of the big reasons for 7702 to come about is a lot of the big whole life carriers with 10 pays were really having trouble putting enough money in to where the policy would look good and build cash value and not be a MEC. So they lobbied for this as well, but it also has a very nice impact, as you can see, on our minimum non-MEC versions in the IUL space. But there's a few benefits that we really didn't think of, that through case design and through working with this, nonstop the last few months. I have my internal partner, Matt Straub, with me. He does a ton of case design on premium finance, and in this particular situation, loan rescue. I'll ask Matt if he can go into a little bit on this loan rescue case, because just real quick bullet points, besides that minimum non-MEC maximum income distribution solve, 7702 has been huge for us with loan rescue payments, policy design with premium finance, and older age death benefit on short pays, to where you can put enough money in now where it makes it to 120, as opposed to before you couldn't put enough money into it and it would lapse around age 90. But now you can solve the maturity or even push corridor and have a better IRR. But in the sake of time, we don't have enough time to go into those. But Matt has the loan rescue teed up right here. So go ahead, Matt.
Sure. So this product we're using here is our Protector IUL product, which has been around for about 1.5 years and is really well known as a low cost, high cash value product that produces strong guarantees to mortality. And it's really done well in the space, especially when people are doing policy reviews, possibly policy reviews on old whole life policies where the premium offset is falling off because the dividend interest rate isn't there to maintain the premium offset, and or there's a loan out on that policy and a high loan interest rate. So what we've looked at is transferring loans over to the policy here. If the cost basis exceeds the outstanding loan, we're actually able to do a withdrawal to basis to pay off the loan, as we did in this scenario in year 2. And at a conservative 4.9% rate of return, the policy pushes out and actually pushes corridor all the way up. And we paid the loan off rather quickly, so we're able to actually maintain a guarantee in the contract. So they're coming over, possibly getting chronic illness or a living benefits coverage. You're locking in a guarantee with no additional premium, and assuming the cash value accumulation, the death benefit and chronic illness pool is going to push up in later years just because of how well the product grows cash and how low cost the product is. This scenario, as Brad says, looks even better in 7702 because this initial death benefit that we need to purchase to bring the policy to get the 1035 over and have it be a non-modified endowment contract can be that much lower. And I'm going to show you a design on a case I worked on. It's kind of an anomaly. They're not all going to work this way, nor would you necessarily design a policy to act this way. It just really reinforces how strong the product is and how effective the new 7702 rates can be on these type of loan transfer or death benefit designs. So here is pre-7702. Well, actually, that's the end of that scenario. This is a pre-7702 design death benefit. We had to buy $514,000 of death benefit. I just illustrated bringing the loan over and not paying off the loan, but I did run it at a 0% rate of return just to kind of stress test it to say, okay, if we bring this loan over, don't make any loan repayments or premium repayments, what are we dealing with? And at a 0% rate of return at current charges, it's still going to run to age 92. Not great. Like I said, not something you would sell, but you're going to understand why I did it when we run it at the next scenario. Second scenario, these are at the new 7702 guidelines. So we can buy a $382,000 face amount. We still have the loan on here, but you can see at a 0% rate of return, your death benefit drops. This is really stressed out, but it continues all the way. And actually the death benefit runs the entire way out without any sort of rate of return on the policy, without any additional premium, and without paying the loan off. So while people look at 7702 and look at the LERP designs and the cash accumulation designs, it really is helping out the universal life world as far as designs we can do with 1035 transfers and maintaining loans in these loan rescue strategies, as Brad mentioned. Brad?
Good stuff, Matt. Good stuff. And really kind of as a wrap up, I mean, you know, the 7702 regs, as Matt mentioned, the minimum NonMEC, maximum income distribution solve, we knew that was going to play, and that works very well. Loan rescue has been huge for us with this. Premium finance as well, to where you can stuff more money in, kind of like a same thing as a LURP or SIP, a supplemental income plan. You can stuff more money in early and then pull out of the loan early and have a less risky transaction in premium finance. And also older age death benefit, like the 5 or 10 pays, you can put enough money in to where the policy at conservative rates makes it forever. And as a follow-up, we have a ton of advanced planning sales solutions. As you can see on your screen, all the ideas that have worked forever, but we're seeing a lot of the supplemental income plan, premium financing. And as a follow-up, you know, Matt can send the advanced planning microsite link to our friends at E4, and you can have access to that. They have old school kits with different charts and graphs that are really client friendly for presentation. And we have a supplemental ledger attached to each of these that you can run right up to the NAIC ledger. And it looks really slick for client presentation. So if you get a moment, take a look at our advanced planning sales microsite.
Thanks, Brad and Matt. Great share and great lead on the loan rescue capabilities now in the new 7702 world. I've opened up the line for questions if anyone has any, or if they've just been dazzled silent. Also, Brad, great mention that you guys are going to be sending us a microsite that we can share with our advisors. Also, this brew will be recorded and posted on YouTube later this afternoon. So if you were interested in seeing the slides again, they will be posted on our YouTube channel. Any questions from the audience? As predicted, they're dazzled silent. Hey, let's go over the drawing. Brad, won't you give us a number between 1 and 21, please?
Oh, wow. How
Minus
about
one,
21?
Tom.
You said 21, Brad? Who's the winner? Oh, so Billy Howard also chose 21. Who's the winner? Who's the winner? Heather Lindsley, congrats, girl. Be on the lookout for a coffee card and a complimentary continuing education course coming your way from all of us at E4. And be sure to tune in next week for the brew. We'll have an advisor spotlight showcasing our esteemed advisor, Steve Walker. For you college football fans, this is one you won't want to miss. Thanks, friends. Make it a great day.